Hi, it's Paul Meredith, mortgage broker with the Paul Meredith team at CitiCan Financial and author of the Amazon #1 best-selling book, Beat the Bank: How to Win the Mortgage Game in Canada. Well, yesterday we saw yet another rate increase from the Bank of Canada. And while there were some economists that had started to predict that we may see a hike yesterday, the vast majority of them were not expecting them to hike. They were expecting them to hold steady, and at least for now. Now, it was widely expected that we weren't going to see any more rate increases in 2023. Back in the March 8th Bank of Canada rate announcement, they announced that they were pausing rate hikes, and they were just going to sit back and watch and see what happens and just kind of assess the situation. But circumstances, of course, can and they do change, because in the same announcement, they also said that they are prepared to hike rates further if they have to, and they are prepared to go much higher if they have to. It all comes down to restoring price stability and keeping inflation under control, because nobody likes these rate hikes. Nobody likes to pay more on their mortgage payment. Nobody likes to pay a higher rate than what they have to. No one likes watching rates go up. But we also don't want to see the cost of everything else going up. $25 for a loaf of bread is what the Bank of Canada is trying to prevent from happening. So they need to keep inflation under control so everybody can, to keep the cost of living down for everybody, and that's what they're trying to do. Now, this rate hike from the Bank of Canada, it's more recent when some economists started thinking, well, we could see a hike on June 7th. And this pretty much started on May 16th, which was when the inflation report came out. And it was the first time that it came in higher in about 10 months. So that broke the downward trend, and that kind of got everybody's attention. And then on May 31st, the GDP report came out and was also a lot stronger than expected. And that's when it started looking possibly like it might be more likely that we could see that rate hike on June 7th. Well, the Bank of Canada ended up going through with that. They increased their overnight rate by 0.25%, which means that prime rate is going to go up by the same margin. Usually once the Bank of Canada makes this decision, the major banks are usually the first to hike their prime rate, followed by the credit unions and the monoline lenders. Now, this puts significant upward pressure on bond yields. Now, bond yields have actually been spiking up since about the beginning of May, and this further fueled them. They were up about 6% yesterday after the announcement, which kind of showed us that the market was a little bit shocked and not expecting that hike. So that puts even more upward pressure on fixed rates. There was upward pressure on them before. This made it even more severe, which forced multiple mortgage lenders to come forward with fixed rate increases almost immediately. So over the past few days, we've seen multiple increases to fixed mortgage rates among virtually all lenders, with more that came yesterday after the announcement. And they're not done yet. The upward pressure on fixed mortgage rates continues, and it's likely that we will start to see more lenders start to increase their rates soon. So it's possible that the Bank of Canada is not done with these increases. Again, they're going to watch and they're going to wait and see what happens. But if they feel that they need to increase further, they will. The tight labor market is really making it difficult for them, because as long as the labor market is tight, then that means wages are rising faster than inflation, and that makes it kind of hard to bring it down, because then when wages rise that fast, that brings up the price of everything else as well. So The next inflation report is not until June 27th. We'll have to wait and see what happens on that. It is expected that inflation will come down. Hopefully it comes down substantially, and hopefully we can start getting this inflation thing under control soon so we can start seeing some lower rates again. Now, eventually the rates will start to come down. It's just a matter of when. Now, if that inflation report does come in positive on June 27th, then it's possible that we could start to see the bond yield start to settle back down, which would then start to bring fixed rates down again. But as of now, there's no sign of them letting up. So if anybody has a purchase that is closing within the next 120 days, or if you have a mortgage coming up for renewal within the next 120 days, make sure you get a rate locked in. You can reach out to us, pmteam@citycan.com, and we'd be happy to let you know what your lowest rate options are. There's currently 5-year fixed as low as 4.69, 3-year fixed as low as 4.99 are still available for some situations, not for every situation. Every situation can be a little bit different. We'll make sure you get the absolute lowest rate on the market for your specific situation, but you do definitely want to get something locked in as soon as possible. It's a crazy time. There is still a lot of uncertainty out there moving forward. We are not out of the woods yet. It was looking like rates were starting to come back down, and it wasn't that long ago when we had downward pressure on fixed rates and we did see multiple drops. Well, those have all pretty much been erased now, and the upward pressure continues. So make sure you get something locked in as soon as possible. Now, I do these Instagram live videos every Thursday at 12 noon. I do a blog every Wednesday, which you can read at easy123mortgage.ca/blog. The topic of the live video is always on the blog from the day before, so you can go check out that blog from yesterday. And hope to see everybody here again next week, 12 noon on Thursday. Have a great day, everybody.